going into the details, I can say that there's a similarity and also different. But if you really want to give a big concept, you can say that asset management is subset of wealth management. Wealth management is a broader concept, and asset management is a specific tool. Just like when you go to see a doctor, you have say, I have a heart problem. No, not heart problem. I just feel uneasy, I'm not breathing very well, and then I'm headache and whatever. You see your family doctor, and then family doctor think that you may have a heart problem, so they refer you to a cardiologist. So the cardiologist is the specialist. So the wealth management take care of your overall health, overall body well-being. So asset management, the cardiologist, but this is too specific. So, but it's not exactly the same. But asset management is still only a subset, and also asset management has other subsets as well. So these are the comparison between wealth management and asset management. So for wealth management, the scope is more comprehensive and including the life balance sheet. What do you mean? I'll talk about it, life balance sheet later. And it is the asset management, the scope is very focused and target, and it's only deal with financial assets. So these are the scope. So that's why you see the big difference for comprehensive approach on wealth management and the life balance sheet, etc. And then for management approach, so management approach is that for the wealth management is more customized. It's targeted to a specific client, and then it's orientation towards the client's goals. So which is more targeted to what the client wants and etc. And then including the after tax, the wealth accumulation. So we help our clients to accumulate wealth. While for the management approach of the asset management is that very standardized and orientation towards relative returns. So it is against the traditional investment or absolute return on the asset alternate investment. So they will have all specific return target, specific benchmark, or specific things we would like to deal with. And also it's more about periodic return. They have a fixed tenor, fixed period, so very specific. These are the main difference regarding the wealth management and asset management. And then for client profile. For client profile for wealth management is that you deal with the complexity of the individual. And then there's many client goals. It's not only one goal. And then the limited investment sophistication. Usually the high net worth individual, they are not as sophisticated as the professional investor or the institutional investors. And they usually have a lot of psychological and behavioral profile. So their knowledge, their personal characteristics, and his behavior will determine your service scope. While for asset management, the client profile, they have less constraints, very specific and homogeneous. Say for example, if I'm an asset management and that I'm managing a global macro hedge funds, I know that the people come to me because they want to invest in global macro strategies. So very straightforward. I don't have to talk to them with other things. For example, if some client just send me that credit fund, and then they purely invest in the bank capitals and the AT1 or the preferred stocks, very specific. So something that this is the asset management we would like to do, very homogeneous. And also the client are more highly investment sophistication, more sophisticated, and the psychological they're neutral. They don't have a specific preference because once they come to you, it's like that. So say for example, like in the asset management company, like for example, like JP Morgan Asset Management or Baring Asset Management or Schroder Asset Management, usually they have two teams. One team is deal with private client. These private client distribution will deal with the private bank. They will sell through the private bank to the individuals. So they don't deal with the end client on their own because they don't have the time or the setup that deal with the individual client's investment profile, which goes to the private banks. However, they do have institutional clients. Then these institutional, they will deal with the pension funds. They will deal with the sovereign wealth funds. So because all these sovereign wealth funds are due to be institutional and investment professionals, they would have to throw the investment personnel in a more common language, so than deal with professionals. That means they will not in the future, if the result is not as good as the fund manager has been described, at most they withdraw the fund. They cannot sue Schroeder that you're losing my money, you misrepresent me. But on the contrary, for the private bank, if the private client lose money, say for example, they buy the Hong Kong China stock and then drop 30–40% in the last 2–3 years, it's so easy. And then they come to the bank that, okay, I lose money, you didn't mention that I will lose that much of money, and then you say it will be good, etc. So there's a lot of explanation. The private bank has to demonstrate to the regulator and demonstrate to compliance that they have explained all these risks. So the selling process, remember, the selling process is a lot longer for the private bank or private client, which right now we are learning about. So that's why we have to specific talk about this selling process and going forward, and then the risk management. So that's why from here so you know that the client profile is so different, and then actually it is so easier to deal with institutional client than the private client. However, the institutional client is very competitive. You have so many competitors to deal with. Yeah. And then the investment, regarding the investment constraints, so what are the restrictions for the investment is that for the wealth management, they will have less, the investment constraints are more dynamic. They can be very, very broad. Investment constraints or can be very different depending on the client's individual profile. Say for example, if the client is a retired government official, they receive a big pension money, like 30 million Hong Kong dollar, and then they live on their retirement funds. So that's why the restriction is that they want to be where the capital should be very safe and then generate income for the future use. So these are something happen, and then maybe on another country, so maybe another client is a very young entrepreneur, and then he sold his business and earned a big chunk of money, and he wants some long-term investment, generate multiple times of return, like invest in venture capital, invest in startup. So that constraint is so different. One is low volatility, one is high volatility, a long-term return. One is liquidity, ample liquidity, one do not make liquidity. So these are the investment constraints we have to know about before we invest for the client. And the constraints are sometimes can be risk specific, and sometimes can be gradually evolve. So what do you mean by gradually evolve? Say for example, if I know some clients, when I knew him, they may be in the mid 40s or 50s, now probably become 70s. So the psychological changes and also behavioral changes will make the constraint will be a lot change. So right now, say for example, before they're earning money for his second generation, now they want to pass his wealth to his second generation. So the requirement is totally different. And also investment constraint, one of that is the tax aware. When we talk to individual clients, we have to, although we are not a tax advisor, but we will advise them or let them alert that when you invest this certain product, you may have some tax implications. Say for example, if you buy US real estate onshore, and then when you exit, probably you pay a very high capital gain tax in the US or withholding tax. But when you deal with institutions, you don't have to mention, because they should have their own structure to deal with this tax thing. So that's why the investment constraint for the asset management arm is more static and infinite, and also tax neutral. So there's a quote from this expertise, say that the responsibility of advisors revolve around both helping families to keep doing the right thing and provide them with as much comfort as possible in doing so. So that's why wealth management is a very long-term business. So you have to walk or hand in hand or along with the client. So that's why we always quote the terms we went through the cycles with the client. That means we went through the bull bear cycle and then the up and down cycle, so that you can deal with them, their mental and also behavioral in a better way, and then you know how to manage their expectation. So wealth management, it is an ongoing process with periodic review and changes. So remember that this is an ongoing process. It's not just like you're selling a fund and then full stop, and then you call another client to sell a fund. So you have a lot of after sales things. Just like you're selling a car, and then after selling a car, you have to help them to do the maintenance, and then when to, if you're good enough, you have to let them know when to replace a new car, new model comes in, a better car, and etc. And then you have to understand the core and macro process of all inputs towards successful wealth management process. There's so many process and so many inputs. You have to take into consideration a lot of factors, which we will talk about later. And it is more client-centric against product and sales-oriented centric. So, and there's 4 interrelated categories, like the client relationship with the bank, the client relationship with the RM or the client advisor and the client, and also how do you define the client profile, and then we have to gradually develop the wealth investment policies, and then on the portfolio management and monitor and market review. So these are the 4 interrelated categories regarding the wealth management process. So okay, let me go back to the. So after you can distinguish between wealth management and asset management, you will find why we have this setup. So for the discretionary investment business model, so we have usually for the private banks, just come back to the practical world. So for private bank, they will have 2 types of investment business model. One is the PB investment model. One is the asset management investment model. So let's talk about the PB first. So usually PB will have a portfolio counselor, and then they will look in the client as a total portfolio approach. And then they will have portfolio manager help the client to structure a portfolio. And then the portfolio manager, under the portfolio manager, they will have research and allocation policy, how to do the allocation of the assets and the risk. And then they have the administration and the execution and the market and product development. So all these product development people will help to update the financial markets and update what's the macro thing, and then how the theoretic portfolio perform. While on the asset management side, they don't have portfolio manager, they have fund managers. So fund manager will be very specific to invest funds or specific investment mandates. So they have fund managers. And then they will have each fund managers or aggregate or fund manager will have their research and investment policies. What they're going to do, what they're going to invest, very strict determination. and then they will have the administration and execution. How is the fund being monitored? How is the trade being executed? And also they have the marketing, product, and development. So you can see that from the right-hand side, the product is the specific funds. And the left-hand side, the problem is the main product is a service, it's a portfolio management service. So if I would like to make the distinction distinguish these two is that they under a portfolio you will have asset classes. Something like that. And then these asset classes is represented by investment vehicles. And what are investment vehicles? This can be individual securities or aggregate there's a term called, they call this a collective investment scheme. Under the SFC definition. So what is a collective investment scheme? That means collective so you can look at the terms that you collect, take so many people's money together to invest. So these funds, mutual fund is one of the collective investment schemes. So if you put it in context, is that asset manager, as I mentioned, a fund manager will invest in one of the collective investment scheme, and then the portfolio manager will choose this one of the investments, choose many collective investment scheme into his portfolio and with asset class, different asset class. So you can see the big difference. So the portfolio manager is talking about more on the top-down overall risk of the client, while the fund manager is looking at the specific area of the specific investment of the products. So I can give you an example. So like can you see here? It's better. Examples like PIMCO income fund. You may see this in the street, in the advertisement on the street. Like, so this is just a fixed income strategy. Or for example, if you buy a capital group, technology fund. So this will invest in the tech stocks. Very straightforward. So very specific. So these like this one can be one of these investment vehicles. So when aggregate many funds together, then you will form a portfolio with multi-assets. So that's why we talk about that when the portfolio manager here, the portfolio counselor, together with portfolio will determine the allocation policy, how much invest in which area, and then we will check it, and this is the difference. So you will see that sometimes they will work together because when you talk about the macro environment, everybody is the same. We're living in the same globe. But while when you talk about into specific areas, then the objective will be different. So what are the in-house models, the pros and cons is that for the good things is provide highly customized products to clients. They can have a high quality integrated service, and the client access to portfolio manager, the client have access to portfolio manager, and there's no transfer pricing because pricing is more transparent, and then full control and accountability. For example, like example, quick example. So everybody know this company, Pictet. Pictet is one of the famous Swiss privately owned bank and asset management as well. They have the private bank in Hong Kong, and also they're very famous asset funds. So like this, they have very strong in Pictet. You can search or see in the Pictet environmental fund, Pictet water fund, or Pictet Japan fund. So these are specific funds invested in specific areas, and they are both belong to the same owner, the Pictet group on the top, like here, Pictet at the top, they have the asset manager, and however they also have the private bank department. So private bank department, when they invest in the Pictet funds, they can always gain access to these Pictet fund managers in a very straightforward details. And not means that these Pictet manager will not sell to other houses, they also sell to other private banks. But with the Pictet, I think they have the, they have the obligation to serve their private bank client better, in a better manner, in a better service. Same for like, when I was in JP Morgan, we have the JP Morgan Asset Management. When they ask them to come to explain their strategy, they will be more willing to do so. Yeah, so this is the, as I mentioned, the pros. Like the client has that have the portfolio manager and also the transfer pricing. There's no transfer pricing, you will not double charge when you import it in the portfolio, because in the US, if your portfolio invest in your own asset management funds, you cannot charge double layers of fees, which is not, it's a market practice. I don't know how the Hong Kong is doing, but when we're in US banks, say for example, the US bank's portfolio, you buy the fund that managed by your own asset management arm, you cannot charge double layer of fees. But when you say you buy the other people's, say when in the portfolio level, you have one layer of fee of the structure of the portfolio, and the asset manager also has the underlying fees, then probably if it's a different manager, you may pay 2 layers of fees. And the cons is that you will have duplication of resources. That means you have to make sure that the bank has able to use all the people or use the resources. It's difficult to build asset management expertise if subscale. That means if you're not big enough, it's very difficult to build an asset management expertise and compete with your competitor. And if under the private bank, you may not fully leverage the asset manager's expertise. That's why in the, like some of the Pictet example, you will allow the asset manager also sell to other houses sometimes. And then you may competing resources, and the performance competition, you will have competition on that. Because, say for example, if there's another Japan fund, if I'm the private bank of the Pictet, and then I find that another Japan fund performance is better than the Pictet Japan fund, from an objective point of view, I should use other Japan fund instead of in-house Japan fund. So that's why these will create some performance competition.
I would like to ask, how much around it is more expensive to have an in-house team than maybe hiring and not in-house team?
Actually, right now more and more, I think a lot of these in-house asset management are being set up long time ago, and then they have successfully built up a very big asset management business, and then they will expand into private bank. So this is sometimes this is the case, and but the Pictet is a very unique case, Pictet, because it's a very big family, big Swiss family. They set up their asset management on their own for their own money, and now they expand to private bank, so they will hire more clients. But for other houses like JP Morgan, they have very big institutional clients already. So asset management, relative the size is larger than the private bank. So that's why the private bank is just use their service instead of dominating the service. Same for HSBC, same for other UBS. UBS, I think the private bank is more dominant. So that's why they may ask the asset management to design product for them. So so that's why very determined. But I think that going forward there will less private bank will have a strong asset management arm, because competition is so. Because you want to maintain a very good asset management, it's very expensive.
Mm.
You have to hire a lot of expertise, and then hire a lot of sales and the compliance, and then research, and then the cost is so expensive.
So, what is the most famous like asset team in the world right now?
What
Like,
asset?
the mainstream asset, I don't know.
Say like for example, like BlackRock is the one largest, I would say also the most common used ETF managers. BlackRock, State Street, and what else? Vanguard in the US is more famous on ETF, and then ETF has a very huge competition to the traditional fund managers because of the transparency and the liquidity, as well as the low management fee. However, it's more passive investing. So I think passive investing become more common because after Warren Buffett said that nobody can beat the S&P for the continuous basis. That's why a lot of people started buying S&P, become passive, and then this passive investing affecting the investment industry a lot. Because think about that. Although I would like to share with you, say which we don't know yet. The actual phenomenon is that, okay, think about that. I think you all focus like the financial market. Assume, say, like you know that U.S. market is going up a lot, crazy in the last couple of months, and then Hong Kong, China is down a lot and a lot. Okay. So somebody say that it is the fund manager, the trader push down the Hong Kong market and push up the US market. But who is behind the fund manager? Think about it. It's the investor. So who is the investors? The institution, the pension fund, or individuals. Say for example, if in the room all of you think that the Hong Kong market will continue to go down, what you do is to redeem your Hong Kong China fund. And then the fund manager has to sell their stock before they can pay you the money. So if it's not the fund manager to sell down the market, they are forced to sell because of redemption. Same case in US and etc. So that's why in the end of the day, it's the generic or the general public psychology will dominate the big market move in the end of the day. Same for the institutional investors. Say like when US, of course, this is a big complex is that when US sanctions certain companies, say like US 2 years ago sanctioned China Mobile, the three telecom company in China, sanctioned the oil company in China. So they will fail, you see immediate slowdown by the market because all the US investors have to sell all these stocks. But after the sell, it will stabilize because nobody will sell anymore because the big investors sold already. So you remember you think about this demand and supply dynamics. So right now that's why apart from learning the fundamental knowledge, how to evaluate company, how to do risk profile, for next year like the year 4 class, when we do the capstone course more about on the managing clients' money, we will incorporate a lot of these real life examples and case studies, so that you know the impact of the capital market, especially in nowadays. So to bring back to the topics, so that's why right now we just introduced the bank business model for the private banks, and then the discretionary investment business model, and then like this is the manufacturer and distribution. So this another model is that the private bank asset management, they have the portfolio RM council. They will use all the asset management expertise and they just become a sales. They don't manage money anymore, so they just purely do the portfolios. So this is more efficient and then more efficient and then cheaper to deliver the service. That means the private bank will not have their own asset manager. So the manufacturing and distribution model is that the ability to create scale, and then they get easier to build assets, manager skill, and enable third-party distributor for the asset management products. UBS is a very successful case. A lot of people will buy the UBS fund, even the non-UBS private bank also buy the UBS fund, and will allow the open architecture for the private bank. And the consultant may not focus on the PB client's needs, and then difficult to align the incentive. So the transfer pricing negotiable may be difficult, because say for example, if you're UBS private bank, you buy the UBS managed product, will the UBS management charge less management fee? No, they will not charge less management fee, charge the same, even if you're charging the private bank, HSBC private bank, because they have their own business objective target to meet. So product may not be catered for the private bank clients at the end of the day. So so I don't see a static business model right now. Actually, it's always evolving. So for example, like some time ago, HSBC just scrapped all the discretionary management capability in the private bank, and then outsourced to the asset management, and then transfer everybody to the asset management. But and also like Citibank, at once they sold all the asset management business to others, so third party. So they won't have asset management on their own. But now, a couple of years they rebuild it. They think that this is not, because when you outsource everybody to outsource all the asset management capability to counterparts or to third parties, you have no control, because you're just one of their clients. So so that's why they want to do some in-house, and then they find that being the in-house, the performance is not as good as outside manager. So there's a dilemma, because you will think, you understand that the private bank or the RM has the responsibility to make sure the client can buy the best performing managers. If they find that the in-house is not as good, and your boss or the big boss want to push the in-house product, then you will have a conflict of interest. So that's why there's a lot of this debate among the senior management among this business model. So that's as I mentioned before, some asset management business trend. So Citibank, like DBS, they exit the asset management business. So right now you will not able to buy a Citibank mutual fund or DBS mutual fund. So Deutsche Bank, PB, and asset management merged and then split again over the past 5 years. So they combine and split, because they don't know how to deal with the conflicts of a business goals. And HSBC, as I mentioned before, HSBC, the discretionary function merged with the asset management. They transfer all the portfolio manager, asset management from the private bank to the asset management team, and then under one manager. Despite that, they may manage, most of them is the private bank's money. And then, as I mentioned, the Pictet leverage their strong asset management capability to expand to their private wealth management business. So the marketing of the alternative investment like PE and hedge funds to more sophisticated clients such as the ultra high net worth and family office. So now more and more private banks would like to sell or market this alternate investment to the PBs. Two reasons. One, they want to bring into this long-term asset, so the client's relationship will be more sticky with the bank. And second, these funds or this product may generate higher revenue for them immediately, and at the same time, they want, and this PE and hedge fund tends to be less volatile in terms of the volatility of the asset price performance. And most of the business trend is that they will employ an open architecture business model, and but however they will have to deal with the competition and compliance issue when you have an open architecture. Make sure that you have done the enough due diligence when you onboard a fund on your platform. And right now, under the SFC regulation or the Hong Kong MA regulation, if the private bank want to sell a hedge fund to their client, they have make sure they have done the overall onboarding due diligence of the fund manager into their platform. Not in the, I think that in 1 or 2 years ago, when a client approaching a private bank said that they would like to buy this hedge fund, and then as long as the fund can be booked into the custodian in the bank can buy it for them. But now it's not allowed. Even it is unsolicited basis, the bank still have to do due diligence on the fund, a certain standard of due diligence before they can book the fund into the client's account. So you can see the regulation is really tough and tougher and tougher. And also some banks will like to be building in-house management capability pure for their own bank or client, like Citibank, private bank, as I mentioned before. They now have a team of internal portfolio managers, portfolio strategies to manage their assets for the private clients. But the drawback is that the performance has to be good. Otherwise, the client will know that the performance of the internal manager is not as good as compared to other external managers. So they may move money away. And while the private bank have to maintain a team of portfolio manager or asset manager, which is very costly. And there's two types of business model. One is called the banker investor model. One is called the single advisor model. And right now still undergoing these changes. So for example, like in HSBC or some Citibank before, long time ago, they have only one single advisor model. That means if you're open an account with a private bank, the RM is your investment advisor. They will do everything. They will open an account with you, they will give you investment recommendation, they will do portfolio reviews and everything with you. All the nitty-gritties. We will call the single advisor model. Maybe they will have another assistant or backup on that. However, because the sophistication level of the client increased, and also the regulator and also the demand for more compliance-related activities. So now more become this banker and investor model, or the bank RM and investment counselor model. That means usually a client will have multi-contact points. Like when you open an account with JP Morgan, you will have always 2-person copy account at least, or 3-person copy account. One is the banker, which is for the overall relationship. One is the investor, which deal with all the investment that matter with you. They give you recommendation. And the other also we call the customer service officer, CSO, which is deal with all the documentations, loan over, deposit, remittance, etc. So that's why the split of workload become more and more clear in this bank. Same for HSBC, and they will also have a lot of investment advisor or investment counselor, so that they would like to compete with these investment-focused banks like Morgan Stanley, like Goldman Sachs. They have some specific doing for investment. And some firms, they would like to partnering with specific asset management firm to tailor specific strategy product or products. For example, like some of the bigger institutional investors, they may not deal with private clients. But however, they would like to expand into private client business. And So that's why they would like to partnering with private bank and then set up a specific strategy for that private bank's client. And then the private bank collectively set up a structure to invest into the specific asset manager as a single product. So so that's why I would say the both parties get the benefit, the mutual benefit. For the asset manager, they can get a new asset, but of the private bank also get a new strategy, which is reliable and may not be offered by other institutional investors. So this will be very common in some specific sector or industry funds or some hedge fund strategies. And then the other issue is that there's more and more these external asset manager or multi-family office or financial intermediary coming out in Asia, especially in the last couple of years, which is mainly the separation of custodian and management. So I can explain a little bit here, so you can distinguish the difference. So we are always client-centric. So usually the client will have to open a bank account and custodian. So actually the banks is usually the bank is also the custodian, but sometimes it can be different, depends on the client. But usually you assume this is the custodian is also the bank. That means you have to put something safe in some place. So these are assets, including cash, and then you will have the banker or relationship manager. From bank. Your bank must be from a bank. And then so you can see that this is a three-leg relationship, right? So you have a banker and relationship manager. The client, say the banker knows the client, and then you work for HSBC, that's why ask the client to open a bank account, and they give advice to the client to transact. Very straightforward, right? It's very simple, just like you go to a premier. When you go to premier banking, you go to a branch, HSBC branch, third floor, and then, oh, I want to open an account and then buy some investment product. So, okay, here comes. Think about who pays. Who pays to him?
Private bank?
The bank, yes. So he is the employee, he or she is the employee of the bank. And so they work together if disputes happen. So in 2008, when Lehman Brothers go bankrupt, the financial crisis, a lot of client private can lose money through the accumulator or whatever products. So when they lose money, they sue the bank. And then they said, because they cannot sue the RM, because RM doesn't have money. It's the bank, they can sue the bank and say the relationship manager mis-selling, misleading them so that they lose money. And then, but at the same time, the client's losing money, but the bank or relationship may get well paid because they trade a lot and get bonus. So you can see there's some
Discretion.
some kinds of how to say, the alignment of interest. It's not right. So originally, in this setup, if the banker paid very high pay for trading or doing transactions, this is in the client's disadvantage. So think about this business model. So how to prevent this to happen? More compliance comes. Okay, after 2008, because these disputes, so more compliance come. More compliance come here to what? How about that? I think it's better that this I want to. So this is the old model, or not the model before the financial crisis. So after the financial crisis, because all these disputes I mentioned, so regulator comes in. So they will supervise these relationships. How? Okay, set up suitability, which we will talk about later. KYC and disclosure requirement. So they will have they set up a lot of suitability measures to make sure that banks sell products that are suitable for the client to invest. Second, KYC, make sure the banker and the bank has do enough KYC of the client record, the KYC record. So they make sure the KYC outcome will be matching the suitability. Also, the last but not least is disclosure requirement. You have to disclose how much you earn, or a lot of disclosure, risk disclosure, etc. So all this will mean to be protect the client by being misled by the bank to do unnecessary business and lose money. So that means the regulator comes to protect the client against the financial world. So you know that is the objective. But do you think we can successfully do that?
No.
Just between this wall? I think that the regulators want to do something good, but in practice, it's very difficult. Because clients, investors are greedy. When you're greedy, you sometimes will do something that doesn't match your profile. Okay, put it this way. Say for example, when we go through all this, we will go through like when the risk profile, when we do the risk profile for the client, and the client come up with the risk profile questionnaires. Finally, come up with a very conservative client. That means the bank can sell nothing to the client. That means then how the bank make money? So that's why, or the client say that the perception of risk is different. And then, if say for example you have put a lot of money in the bank, and the bank say that you cannot do investment transactions with me because you say you're very risk averse. Okay, actually I'm not that risk averse. They will change the risk profile so that they can buy the product from the bank in order to make money. Because you have to take risk before you can make a return. It's very straightforward. Because in the old days nobody talk about this. and the client never understand it. So that's why there's a lot of education required. So because of that, so many things regulator comes in. And these compliance and regulations make the life of banker and bank very difficult. Because if you go step by step for all the compliance, like voice law, risk disclosure, basically you can't do business because it's cost so high. You have hired so many people to do this compliance thing. That's why a lot of these bankers who left the bank. What do? Because the good thing is that they would like to service client by providing investment advice. So that's why they come up.
Family office.
Yeah. That's why they come out to set up a multi-family office or independent financial advisor or external asset manager. So to come up that, so that right now these IFA, EAM, become part of the elements of the wealth management cycle. So what they will do is that they will have a relationship with them, they give them advice and manage money. At the same time, but the money is not under the bank, the money will never pass to the IFA. They just give advice. And all the money will still with the banks. So in terms of safety, it's very safe. He cannot move the money. He can only give advice or manage the money as a separate account with the bank. And then the banker also serving the other things like the custodian, the remittance, and some other thing. He can also give advice, but you have another person to counter check whether the advice is good.
In line with your interest.
In line with the interest of the client. So that's why the alignment of interest become a lot better. But of course, he has to pay a bit of fees to the external asset manager, etc. So this is come up this kind of thing. So that's why you see the change of landscape. Okay, I can give you a specific example. You know how bad the regulatory environment. So I don't need to write. So when I was in the bank, my staff told me that in the morning that one of the clients sent a very long email complaining the bank. You know what his complaint? He's complaining the bank why don't let him to buy a specific stocks in his portfolio. Okay, let me let you know the background. The client is a hedge fund, is a private equity principal. He is a licensed person. He is a professional investor. He managed a private equity firm. And then in the night, he did some research and want to buy some specific stock in the US equity market. And then every day they buy the same stock. They just try to accumulate, he like to accumulate his own account. And then buy to a certain level, the bank said, your concentration, you cannot buy anymore. The night desk trader do not execute the trade for him because according to the bank, it is concentrate. So the bank have a limit that up to certain level they will not buy for you. If you have if you are 1 million, maybe up to 30% they will not buy for you anymore because concentration is high risk. So that's why he complained. What he said is that, okay, one, I don't take your advice, this is my own study. Second, this is my own money. Third, I didn't borrow money from you. Third, if I lost, this is my own responsibility. And fifth, this is how I make my wealth. Concentrate the bank. Why don't you let me buy? So what do you say? We talk to the big boss. The big boss said that, yeah, this is absolutely right. Right. But the compliance, because you have to set procedures that fit into the regulator's requirement. Okay, what they can do is that they issue a lawyer's letter and then ask the client to sign that, okay, this is what I want, a legal verdict that I want to make concentrated on my portfolio, blah, 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 something like that. Then they start to let them to buy still up to certain percent, not 100%. But the client say, oh, okay. So you see that this is, right? this is something that like the real world happen, the regulatory thing happen. But do you think the regulator is helping the client? I don't think so. Because the client has know what he is doing. Okay, he can protect somebody that doesn't know what he's doing, but he will also affect the whole financial world, because otherwise the capital market will lose this
freedom.
Freedom and also the function. Because why the U.S. like tech stocks, small tech stocks the venture capital has grown up so fast, because a lot of people like to take risks, take bets. I invest in the venture capital, I invest in this startup or small tech company. I hope to make 10 times, 15 times in futures. But you know that I may lose 100% of the money. That's the risk and return. But if you don't allow the people to do that, who will invest in new technologies? Nobody will invest in technology, because the government do not allow people to take risks. So I think that is the pros and cons of the regulators. So, but the regulators, you know, the objective is to protect and then make sure no noise. So this is something that you have to learn about it. So this one example. So in that case, and same things happen that like in my era of when we actively investing for clients. Say when we meet the client, say for example, I want to invest say like 10% of the portfolio into these blue chips, U.S. equities. Then when we go back to the office, then because we have been discussed with the client what kinds of stock we buy. So we will immediately buy for them and then send them the confirmation will be okay. But nowadays, it cannot. So you have to voice stock, call the client again and say that I will buy this stock at this price, blah, 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 all these things very specifically without execution, before execution. So that's why it will create a lot of time and inconvenience in doing the genuine business. But I would say that somebody will misuse the previous convenience to do bad things. So that's why we have to strike a balance between the risk and business. So this is something that a bit away from what we have discussed, but I think this is a good thing that you learn why things happen. A lot of people, why so many compliance come up, and then what's the purpose? Okay, and then we have to understand where it comes from, and then just like everything, you have cycle. You will swing from this side to another side, and then gradually come back in the middle. So we hopefully we will gradually coming back to the middle. But and also we know that they are now start to considering, because otherwise it's very difficult to conduct business, and the cost is so high, and then you lose your competitiveness as financial centers or other centers. Yeah. Okay, the last point, how compliance affecting investment business models. So that's what I've been discussed. So this compliance affecting the business model is that they will implement a lot of jobs. They will create a lot of compliance related jobs. However, we will affect the real business of the private bank or management business. So usually in the portfolio related business, the US, Europe, and the Asian investor will have different focus. So the US will be more on the core portfolio, and then all of them are discretionary, while they may have some satellite portfolio with discretionary alternative investment. Why? Because the US and Europe investors are more of a second or third or fourth generations. So they are no more engaged in the day-to-day managing of the financial assets. That's why they were more discretionary product. While in the Asian investor, they may have some core concentrated holdings like single share, like major shareholder or listed company. They're major shareholders, and then that's why they have the core holding is the single shares. For example, the large Hong Kong family like Li Ka-shing, like Shen Long Gai, the core holding is the listed companies. And at the same time, they may have some discretionary portfolio, but not in very big size, but they also may have some satellite non-discretionary single line portfolio because they want to involve in the day-to-day managing. They want to know, they want to talk to bankers, they want to know what's happening. They would like to test their views. Say, for example, I think that Tesla will be a very good stock. That's why they accumulate Tesla for a long time, and then we could buy it, become bigger holding, and then etc. So these are the single line products. And then I recently talked to a friend of mine, and then he gets a big client in Hong Kong. He's a famous celebrity, his client, and then I just what they're doing. They said they make a huge fortune in Tesla. They just put half the money in Tesla and they make a good fortune. But is it right or wrong? Nothing is right or wrong, depends whether you can do it or not. Yeah. Talking about more than 100 million US dollars. So why low penetration of discretionary products in Asia? So these are the main reasons. So as I mentioned before, the US and Europe are mainly inherited wealth, and then they will rely on professional managers and asset managers. And then they are the sophistication level is pretty high, and they also like to take a long-term view. And their risk appetite is a lot diversified, and also they usually have their own firm's business strategy, and then some of them even use one firm only, very individual firms, and the RM's continuity are pretty steady, and also the regulations does not allow them to trade too much, and the cost of transaction is a bit high. So that, and also they have a very developed capital market. And for the Asian investor, I think the main reason, the first couple of main reasons, that the entrepreneur is still the major business owner. That's why they engage in the day-to-day conversation. They will compare investment return against their business return. And the first generation may not be financial savvy, so that's why they would like to focusing more on trading and speculation. And they invest in real estate. And in terms of financial market, they usually have a more short-term view, and they have multi-banks. That's why they would like to they will get more information from different banks. I would say they're more like some of my clients. After they retire, they said they would like to learn more about the financial market. That's why they want to involve in the day-to-day trading. And also the RM turnover and the compensation will how to say that, there's a lot of the RM like to change jobs. So when they move from one bank to another bank, that's why they would like to bring their client to another bank. If their client already engaged in very good discretionary business, so they will very difficult for them to move their asset again. That's why they would like to keep the client do advisory or trading business, so easy to move away. So think about that. If you're in a bank, you engage the client, you do a private equity. You know that private equity usually is a fixed tenor of at least 7 to 10 years. That means this trunk of assets they cannot move away. So this is for this, you can say that for the selfish reason, they would not like to engage too much on the discretionary business. And there's also the regulations. Right now we step in, we're affecting the Asian investor, and also there's a less developed capital markets. That's why people like to do more advisory or less discretionary business. So as I mentioned before, so right now what are the trends? There will be more gradual increase in penetration of discretionary management products in Asia. I think the market volatility is just so high. You really difficult to deal with on your own. That's why also the rise of family offices help the client to do a more diversified and then risk approach, help them to manage the risk. And also there's an increase in compliance cost of complex advisory products. Examples like the equity derivatives we will talk about, and COCO we will also talk about. Because of these complex products, the regulator will require the bank have more and more precise risk disclosure on that. Even some banks will give a video and make sure the client read or watch the video, confirm they understand the video before they can come into the product. and mainly for the bigger global banks who have the expertise and scale. And the aging population of high net worth is also, I think, important that because like I've looked at the industry for more than 20 something, 30 years. So the client is growing with me. So I'm becoming more mature and then become older. So that's why the client may not be too engaged and do the trading on a day-to-day basis and increase the number of good and I think this push and pull factor, as long as there's many good managed product and good managers, they can invest it into or they would like to choose. That's why they would like to willing to put money into discretionary product, and also the transparency is improved, and also they would like to use the alternate investment product which can help them to fill the gap of the traditional assets. So I think all these are good developments for us as a wealth manager. So as long as the market become more broader and then more sophistication, I mean the depth become higher and the width become wider, so that we can have more choices and then we can pick the right product for the client to manage their portfolio. And that's why we can have we can hire more people, and then also the sophistication or the specialization will be a lot wider. So I'm happy to announce that in middle of March, I will invite one of my first good friends and colleagues from bank. He's the head of private equity and hedge fund. He will talk about the development of the product in the market and also how a portfolio will use hedge fund and private equity. So it's a real case studies for you guys. Okay, maybe we take a break first, and then we'll continue the second part.
不行，这样，不行，这个好，先走那个。
Are they going to change the password? No, not yet. They know that. Because you can understand. Yeah, each row is 12, right? 1, 2, 3, 4, 5, 6, 7, 84. 84. We have 80. in any case, you still need a bank to put your money. So that's why our bank. Yeah.
So, you mentioned that asset management is also a subset of wealth management, so I can understand that there is wealth management and then private management, asset management, and there's a full set.
她怎么漂亮？
Yeah. So wealth management is, I'm not exactly subject, but asset management can be a subject of wealth management. Asset management can be subject of wealth management, but also asset management is standalone because they have the yeah. So like for example like Pinto is a total institutional asset management agency related to private bank, but for Philippines they have asset management in private bank, like you get asset management in private bank. So that's why their roles have been confused sometimes. It depends on the management. How to evaluate.
They have custodial banks and then there is individual RM.
你可以尝试一下女生版是什么呀？就是双重经济 double。太多了，你只能承受一个是吧？对，这一个。快借我笔记抄抄。第一节课。好。她是不够漂亮，不跟贴。她出轨，她爱出轨，这不行。不行，就这样。这是哪一套？我要选超胆那一套。
好，Thank you so much。
没有电，我自己装。
对，确实没电的话，
我该从哪儿抄起呢？
It's like very different. Like if you want to do
时间不够长。
可是我到时候把这块。So for us, like if you want to study like I guess public banking or asset management, we go directly into like asset pricing. We don't really do like
哪一个？其实我也想看美股。
So I want to ask you like because what I'm interested in
参加班被
is
签署你以为他上班了。
about like how you going to talk about the Asian private banking and whatnot.
朱莉是个学姐。
对，哎呀，
我好像知道我没有看这些股。人家会很喜欢。
The private banking industry is more because of
直接让你放到各种论坛上说。
why we're growing so fast is because so many do well. So that's why they need this service. And then the growing of this wealth is so fast. That's why the client is not up to the maturity level to understand everything. That's why a lot of leakage. The system. That's why so many bad news come out. So if everybody is so experienced, everybody is so well educated, you won't have like fraud.
但他现在可就换个位置坐，离他远一点，让你得不到。所以我觉得本来我也不在这个范围内嘛。
That's why it came across several crises. That's why people learn smart. We didn't come across several crises. So like you have the 0708 subprime credit, inflation links, and also tech bubble. But during tech bubble, the China market still very young.
勇敢人先被抓去警察。
like I want to work as like an expert.
Yes, of course. Yeah, absolutely.
Because like what would I know though? Like I get that like it's not as simple, but like I'm going to learn like why. 就是刚才不是说突然这个嘛，然后突然那个，我就很累，然后我一下就感觉要干嘛。
Because you can understand. Of course, you can say that when the market is less developed, it's more challenging and more profit for everybody. So that's why the banks increase the profit. They don't want it to be so regulated. Asset pricing is purely on
numbers, right? Or what these two aspects, what about this cost will add to the asset price?
this is more, we will talk about asset pricing. So these are investment theories. decades of knowledge. Therefore, we need prerequisite lectures. So I will not teach what's the learning system, what's the option, but we will teach how to use it, how the bank use it as a product.
In the Asian market.
Yes, in the Asian market or actually in the other markets. And how we apply this because this book is from US.
Yes.
So how we apply this knowledge into our daily life. So some of them is very aligned, that some is not aligned. Because we never because we different market, different kinds of people. The US is everybody.
我终于知道我每次在大海上跟我朋友表情，应该就是想的差不多。
Wait, last week we're like right? Like a lot of classes, like just like in reality is not what like in the best for actually use it.
刚才有这个没有，你要自己上那个。哎，你要自己上那个平台是到底要？它是几个？
Thank you so much for
那我们是几个？有啊，有。他传过来一个人一个人。对，凯文，现在没电脑。
I pass the attendance around, make sure you sign only for yourself. Please do not sign for someone else. I noticed last week someone signed for his or her friend. Please, I'll count the number of people in the room and then I want to see that number on the sheet alone. Please do not sign for your friend. If I am able to trace and get to know that you are the one who signed for your friend, that will be a deduction in your mark. Thank you.
thing I would like you to remember in the wealth management business, this is it. So this covers everything from end to end. So, and then what we will talk is that in the rest of the classes, everything is related to this. Some I will spend more time, some I will not spend time on it. And then, but right now I would like to give a briefing of what it is. Okay,
I haven't signed.
the first part here, from here to here, is client profiling related. It's the one you gather all the client's background, client's information to do analysis. And then here we review, and then we will, here is more in the investment related. This is client profile related. And then with this is more on the review of the whole relationship. So basically it's three parts. One is the client profiling, second is investment, and then the last is ongoing continued review. Why? Because as remember that we talk about wealth management process is an ongoing process. That's why it never stops once it started. Once you have money, you have accumulated certain wealth, the process will start. So if you don't have money, basically nothing involved here. So very straightforward. So especially next year for the people that on the class next year, this is part of the thing that you will do it on your own to for client profiling. And then the work will, and then the final project will be on the building of the portfolio. And okay, this is the wealth management process. Then we will go through it on one by one later. So first one is the client relationship and client profile. So in the work, in the industry, you will always hear about the word KYC, know your client. You have to know your client before the account is opened, or on the process of opening the account. So the client profile is including what? Including the client and the family background, including the education, age, family members, and then what is the client goals. So in nowadays, when you open a bank account, the bank will ask, why do you open an account with me? What do you want to do with me? So the client will ask. So that's why the client's goals. And then afterwards, we have to know the client's risk tolerance and risk capacity. So I will distinguish what is risk tolerance and what is risk capacity later in later lectures. And we have to know the client's behavioral biases. So if anybody take a lecture on behavioral finance, you will know what I'm saying, but we will touch base on that in the later. And then what is the client's constraints? What's the limitation of the client portfolio? This is not only on financial constraints, but personal constraints, and family constraints, etc. And then we have to know about the life balance sheet. This is more related to individuals, not only big family, but individual that has a professional, etc. So not really related to ultra high net worth, but general high net worth. Tax profile here I will not touch because in Hong Kong our tax very simple tax jurisdiction, but in US, because this is from the textbook, the US is very focused on tax related methods and the market expectation, and most of all is that how is the clients expecting from the financial market? Does it match the real world? Or say for example, a client comes to the bank and say that, okay, I want to invest my money with your banks. I want 10% return, but no volatility, or very safe. So which is the expectation is totally wrong because it's impossible. Because right now the financial market, maybe the deposits is maybe only 4 to 5%, and then if you want to 10%, you need to have certain degree of risk. So this is the client relationship and client profile. And then this is the example of a life balance sheet. So think about that as yourself. You have, when you're grown up, your in your age, you have asset and liability on your own. So remember, in the balance sheet you have asset and liability. So what are they? So these are one of the examples in the textbooks that saying that, say the assets, including say like house. I have a house, is my asset. I have other stocks, it's my asset. My investment in financial stocks. And if I work in a company, I have a company stock usually shared to me. Maybe I have also company stock options, or these are my assets. And then net employment capital. Say for example, if I work as a financial engineer or a system engineer in Microsoft, probably you will know that you have a very good job, and then if you do it well, you have pay bonus, and then you can have a salary raise, and also have what else is the ranking, and then higher rank in the future. So this is the net employment capital. So that's why when people buy insurance for senior executive, insurance company will like to take the insurance policy for even for big amount. They like, these are the assets of a single individual. And then what are your liability? Your house. So under normal circumstances, you may have a mortgage. Then college. Say when you have son, you have to make sure that your son and daughter will have enough money for the college in future. So that's your future liability. Retirement. Say if you say you're 40 years old, you calculate when I retire in 60 years old, how much money do I need? So these are my future liabilities. And also the discretionary wealth. So they, okay, I would like to leave $1 million in this example for my siblings. So these are the liabilities. So this is a typical life balance sheet for an individual. Under these circumstances, probably he may not be qualified as ultra high net worth individuals. But however, when you never know. So for example, like in this case, if this is not a Microsoft staff, it is Alibaba staff. So he has working as Alibaba, one of the senior executives. But before the listing, he got company option as Alibaba shares, and then also stock from Alibaba shares. And then once the Alibaba share got listed, he gets, say for example, he get 1 million share, then he become an ultra high net worth individual. So you never say never, you never know. But for these individuals, say like if it is Alibaba senior executive employee, probably he would like to buy a house, maybe borrow mortgage from the bank. So he will also want to make sure his sibling, his son and daughter will have good money if he pass away or whatever. Or probably he may buy life insurance for his future generations, and also may leave some money in private bank as a trust. So we call it. So that's why when you know the client clear enough what he owns, what he has, and what his concerns, then you can create business opportunity for you. Say for example, under these circumstances, I'm a commercial bank, so okay, I can help them to get a mortgage, I can help them to get a children education fund, also I can help you get a retirement portfolio. So these are the business opportunity for me. This part probably I can't have because I cannot deal with the stock options if it is not listed. And then he is under employment, so I cannot do anything. So, but because of that, I can do about that. So, if on the reverse, if you have another client that his company got listed, or his company being buy out by a private equity fund, so he may get a big chunk of cash on hand. So probably he doesn't need mortgage. He will pay down his mortgage. He doesn't need to set up a fund for his children because he has all the money already. So in this case, that will be a total asset management client because he has cash. He wants to generate cash for his clients. So you can see that different type of client will generate different kinds of business opportunity for the private bank or wealth management or wealth manager. So that's why KYC is very important. You have to know the client's background. So after knowing the background, say for example, you think that this is now not the right time to do the asset management business, probably you will focus this part of the business with the help of other banking sectors. If your bank doesn't have this service, probably you have to pass. This is not your right kind. You'll find another one. Don't waste time. This is not mature yet. The mature, maybe you can keep contact with him when you know that he's a monetization case. Say for example, his company got listed as I mentioned before, then he can become your private bank client. But you cannot do that until the monetization. You have to keep the relationship warm in order to wait for the event to come out. So this is something that you have to learn about it if you enter into the industry. So that's we call the life balance sheet. So any question? So think about that. If you're I think all of you have to study accounting. For all the assets will have a liability. It is a must. So disregard what you are. So even you come from okay. Yes.
You first.
Yeah.
What is the leverage of 2.8 means?
2.8 times.
Yeah, but leverage from what to what?
Okay. From 1 to 2 point. So his 2.8 million total will become 1 million. So this is 2.8 times from 1 million to 2.8. This is how they describe the discretionary wealth will be 2.8. This Commonwealth will be 2.8 times as discretionary wealth. So you can forget about this leverage.
Okay.
Yeah. Doesn't really mean leverage. Yeah. But this is something that happened. So this is another illustration. So at age 35, you have an income of 50,000 and income increase with inflation, and the real discount rate for the future income and mortality rate of 5%, and the initial portfolio amount is 100,000, so real investment return is 5% per year. So you can treat that, say, this is something that insurance company will calculate how much insurance they would like to take for your life. For example, like if you are Jay Chou, so everybody know who's Jay Chou, right? So he's a pop singer, Asian singer. So if Jay Chou want to buy 100 million insurance, do you think the insurance company would like to take it? So the insurance company will say, does Jay Chou worth 100 million US dollar? So basically, okay, Jay Chou show that okay, this is my salary or this is my income for this year. I earn 20 million US dollar. If I continue to do that with the say with the say delivering musical concerts or sing songs and etc., probably I can make so much money. That's why if Jay Chou say if accident he cannot sing or die, whatever, so his life really worth that kind of money. So this is how insurance company think a person that worth that kind of money. Say for example, if Jay Chou want to buy 100 million US dollar insurance, and the insurance company that by paying rate 25 million US dollar to buy the 100 million US insurance, and then the company that proposed that the insurance company underwriter proposed to the company to substantiate that Jay Chou worth 100 million US dollar. So this is something that the concept of the life balance sheet is they use all the discount cash flow to calculate the NPV. And also these two lines show that for the private individuals, usually his financial asset will grow along the age, while the human capital will decrease. Say Jay Chou now is 40 years old, so when he's 60 years old, his human capital will drop to almost zero because nobody will listen to his singing or whatever. He's no way to make movies again. But this is something like what happened. So this is the concept for you to understand the human capital and financial capital. So that's why. So a lot of people will say that when I was in the previous banks, so one of the compliance officer or the private bank back office said, why do you want to say sign or a client that is doesn't have that much money here right now, financial asset. So Then the RM told the client that, told the bank that you don't know what happened in futures. So if this is a rising movie star, they just like a sports company, they sign this young sportsmen.
Potential.
So if you don't, so for example, like Jay Chow, when he's just a young singer, he's $1 million. If you don't open an account with him, then somebody will open it. When he has money, he will not think about you. So this is something that's why when doing investing, you must have a long-term view, not only for financial assets but for human capital. So this is something that we learn from here. So something about the financial behavior is that human capital is just an allocation of consideration. So for example, if your client is a government official or is a famous doctor, famous physician, probably he's just like a bond-like career. That means his income is quite steady. He will not have exponential income. If you're government official, senior government official, senior accountant, so you will not make double of money or triple of money in 2-3 years time because you're very consistent, very high pay. So you just like his career like a fixed income bond career. But however, if you're owner of a business, you're an investment banker, so we would treat it as an equity-like career. That means he may have suddenly a jump in business, jump in income, or jump in extraordinary income. For example, an investment banker suddenly get big bonus because of good year, or business owner, the company was being bought by another company, so you have a big, huge monetization. We will treat him as an equity-like career. So from the diversification of risk perspectives, so for a bond-like career, because he has steady income, so you should invest more in equities. That means he will have a high return for this asset class, because this will mitigate the risk of income. But for equity-like career, because his business is volatile, or his underlying career is volatile, that's why you should invest in bonds. That means he will, in case he loses his job, if business doesn't work well, he still have some income or safety of capital. So this is the concept of diversification, and then really apply. So I remember that in my previous working banks, we have a team that approaching the private equity sponsors. So when we approach one of the CEO of the private equity firms, actually what we talk to them is that we help them to buy fixed income only, buy bonds, and then buy house to have steady income, to diversify his equity exposure. Because think about that, for the private, so you know the private equity managers, where do they get the biggest payout? Is when they exit their business. You get the carry, you get the share of profit. Say for example, when he sell the company in 2 times earnings, he will make 20% of the earnings. So that means his whole wealth is already tied up with high risk, non-liquid investments. So that's why in order to diversify the risk, we will recommend to buy just investment grade bonds, diversify with a steady income stream. Because they don't have steady income stream apart from salaries. Their salary is just enough for make the livings or a good living, but that's it. No substantial incremental wealth. So that's why we diversify his exposure. He should not invest in other private equity because otherwise too concentrated. So this is the one of the concept of diversification of risk. So when you have a family business as an allocation consideration, so bond-like business should have invested in equities more to compensate your growth and return, like land loss, shopping malls, or garment manufacturer. We would treat this as a bond-like business because garment manufacturing should be pretty steady, and then shopping malls, you're collecting rents, landlords, you're collecting rental income. So your income volatility will be pretty low relative to equity. So that's why you can invest in equities. While for the equity-like career, like property developer, fashions, tradings, if you're just as I mentioned before, like private equity, you're already an equity-like career, so you should invest in bond in order to diversify your risk. Otherwise, if things turn bad, you will be stuck. But however, a lot of cases in Asia is that some people that like property developers, they think that they know the real estate market. When they have money, they still like to invest in real estate related business. When things turn bad, like last 2 years, also. Right. I have a friend, as I don't mention New York, not his client lost 90% of wealth in 2 years' time. Yes, because he's heavily, he has a major shareholding is in one of the property listed company in China, and he doesn't want to sell because he has been doing so good and then paying good dividend every year.
Hyundai?
No, Hyundai is 100% loss. So I'm very sad that because I know this guy as well, and then he knows that we have been recommend, and my friend recommend him to sell his share. He doesn't want to sell because he thinks it should be okay for the next many years, but nobody knows that what happening. Nobody can guess, say, estimate what's happening in the China property market. And then no more than things about things happen. And I also a real case is that I know that in year 2000, which is I think all of you are very young, that was tech bubble in those days. The tech bubble, the internet bubble in 2000, and NASDAQ was making new high at those days. And I know that because some private banks, they help the client to do this option, the caller option to protect the client's wealth. In case it drops 30%, he will still get 30%. And because of that, they save a lot of tax, major shareholders as well. Say, because some of the tech firms really drop 80-90% of the share price value in the tech bubble, during the tech bubble. And because they're selling the buying the long data put option very cheap. And then because the option price, strike price is 30% of the current market price, that's why it's so cheap. That's why he's willing to pay a bit of the premium to buy. And which is this premium save their residual wealth, because otherwise his share price drops to only 10%. You can imagine, compare 30% to 10%, is 3 times. So don't underestimate these kinds of hedging instruments in future when you deal with the market. So after knowing the clients well, we should write, or we should write an investment wealth management policy with the client. So this wealth management policy, not necessarily in a very structured format, but should gradually or roughly including all these things incorporated, because different clients will have a different perception in dealing with banks. So if you're writing too much, they may be hesitate because they were afraid, how come you have so many things to write up? But all this will be within a discussion with the client, so that, like, for example, like you will have the internally, you should have a brief description of the clients, where his money coming from, the client goals in terms of wealth management. I didn't mention the KYC part and the source of wealth part, which is related to the compliance issue. So what are the investment objective? What are the return risk objective? What is investment constraint, including time horizon, tax, liquidity needs, legal and regulatory concern, any other circumstances? What are the strategic allocation after understanding constraints? And then what can be done, what cannot be done? How do we implementation? Whether we need which jurisdiction they would like to put. For example, right now in US it's simple, so you just put in US bank. But for Asia, Hong Kong, here in Hong Kong, a lot of times we have concern, like where should I put the money in? So somebody would like to put in Singapore, somebody think Hong Kong is okay, somebody would like to open account in Geneva, in Switzerland for super safe. Somebody want to put open account in US, think the US system is a lot better. So this is why a lot of choices, and that must be reason on that. So for custodian and any other parties involved, say for example, do you want to involve a third party lawyer regarding trust and etc. all this stuff. And then we will talk about the how to rebalancing, any guideline for rebalancing. If we're wrong, what should we do? If our view is wrong, how do we review it, etc. And also the risk management and insurance. So what are the risks on that? I would say the risk is here mentioned is that some of them are very specific, some of them are very generic. And I just want to introduce two concepts. So the risk of living too long and the risk of dying too soon. So think about that. So what are the risks of living too long?
You have not enough money to
Yes.
spend in your.
You have not enough money to spend, or you have health problem. You need a lot of money for the deal with the medical problem. So what are the risks of dying too soon?
Your property is still in repaying mortgage loan, maybe.
Yes, partly. Yes, you have children, your kids. You have to deal with their life or the grown up expenses, or you have some liability, or you have a company, a startup, and then still running. Say like for example, like I think maybe everybody knows about the company called SenseTime.
Shentong.
Yeah, SenseTime will be one of the most famous AI company in Hong Kong, listed in Hong Kong, and then the founder died late last year, in the age of 55. I think it's very sad for the team and us. We lose a talent, but at the same time, I think the company is also tough because he's the leader of the company, so that's why dying. We call this dying too soon. So he doesn't finish his thing yet. So that's why. For company like that, usually we should recommend the client to buy. We call the key man insurance. So if the company have that kind, that's why if anything happens, that's why for hedge fund managers, when we do the due diligence, we will ask, will the company will buy a key man insurance for the fund, because if the staff, investment manager, fund manager, if he pass away, actually the fund nobody will know how to run. So that's why the key man insurance is very important for this kind of thing. That's why it's part of the due diligence process regarding. So these will more related to different kind of risks, including the wealth transfer, etc. So that's why for the wealth management policy, we will describe from the clients end to end, from who they are, what they want, and then how do they want to build the wealth, to how do they pass the wealth. All this is from end to end. Yeah. So think about that. If you're a private banker, you have, when you meet the client several times and then you can illustrate all these things, I think he will be very impressed. So they think that you can help to take care of his wealth. So regarding the investment policy statement, this is same. Investment policy will be strict to just purely investment, excluding the wealth or succession related area. Okay, so we are optimistically want to collect all the information. However, sometimes, or not sometimes, most of the times, it's very difficult. These are the issues why it may not be difficult. So client may not want to reveal too much information. Example, his true net worth, his total investment portfolio, which is shared among different firms. So he may not like to disclose to you because he doesn't want to trust you, or he don't trust you, or he doesn't think that you have the capability to do everything for them, or they don't want to disclose too many things because you may misuse his information for other purpose. So that's why they want to protect themselves. So client may use different PB firms for various needs, depending on each firm's expertise and reputation and charges. So don't remember that we think that the private bankers easy to jump jobs from one firm to another firm. If I tell you too much, so when you go to another firm, that means my information will be leaked from this firm to another firm. Because whatever it is a compliance thing that whatever the client's information told to the banker is supposed to be recorded into the system, the database. So that's why the client sometimes they may be reluctant to just really tell them everything. And some firms may just want to satisfy the minimum regulatory requirements to write down what is necessary to fulfill the regulatory requirement, and that's it. Don't write too many things, because if you write too many things, you will lead to too many questions to ask you to comply with. Say for example, if they say if the client tells you that I have some investment business in the U.S. and then I have lived in U.S. for 20 years before I come to Hong Kong, so sometimes then they will the bank supposedly will ask, are you a U.S. citizen, etc. Because if you're a U.S. citizen, so some of the Asian bank cannot deal with a U.S. citizen to open an account. But because the RM may not want to lose the business, that's why he will not ask whether you're a U.S. citizen, or if they know the client that want to hide the relationship, doesn't want to really take out onto that. So if the client say bring in a Hong Kong passport or a Taiwanese passport to open an account, so they will just keep using the Taiwanese passport or Hong Kong passport as the account identity. So don't want to deal with the U.S. tax related matters. So this is really that banks will just try to satisfy the minimum requirement. And then the behavioral biases are not easy to assess. Why we say that? Because people will not disclose or will not express his real behavior, reflection of his behavior, unless it is in crisis. So you will never know what's your response if you never engage or it never say was being put into that situation. Say for example, if you have like the example I used, say like the client originally have $100 million because of stock crash and his holding dropped to a certain level, then his behavior will reflect the financial market will make him or her to reflect his true behavior when he see a big drop of wealth. Some people will be go crazy. Some will be say that okay, I still have 20 million, that's still okay. So it depends on the I would say the different people's
mental capacity.
Mental capacity, yeah. So client may just look for unrealistic investment return or use short-term benchmark which leads for high turnover of foreign products. So these are the issues. And then because if say for example the client say that I don't want to invest in long lockup instruments, but I want to high returns, that means they need leverage and speculations. So that's why we mislead the bank to do something which is unrealistic for him. So and also they may complain. And they come back, they may complain, why do you do this for me, or etc. But because they said that you want high return but high liquidity, that's why this is the only method to get high return into leverage, right? So too much emphasis on non-discretionary or transactional product would make investment policy statement irrelevant. So that's why if the policy statement with too many speculative products, so which is useless to have that policy, because the policy statement will mean to be long term. Okay, that's the end of the first part of the wealth management process. So so here we will just describe a bit of the client profile. So I will go over the like the behavioral, the risk tolerance, the tax market expectation thing, including the business, investment policy models, and also the risk tolerance and the constraints in the later lectures. And afterwards, we will talk about the portfolio management and portfolio monitoring and how to do performance evaluation. And then something which is not here, I would incorporate managers, more about manager selections and also the structured products, because this is in the region that the use of structured product is quite welcome or quite common in the region. There's a lot of valid reasons on that, and also that's why I will have a specific lecture on talking about the structured product, how to use it, and then how to use the common structured product, and then what are the pros and cons of them. And then also we will have a lecture on financial successions, including trust, including what's a trust, and then succession planning, and etc. What else? Okay, that's it for today. A bit fast. Okay. Yes, sorry. I forgot. I supposed to tell you about the KYC stuff. Maybe next lecture.